And as we talk today, we got to talk about one of my favorite things, which is our process at Akers Financial Group. We start with your financial fingerprint. Every time we meet with you, we talk about what's going on in your life. How about your cash, your income, goals, things you need money for? Because that truly helps us decide how and what to do for you. Now, this is financial planning at its best. We then talk about those goals and those dreams. Then we're going to be able to advise you across everything. The more information you provide to us, the better our advice will be. It's sort of like going to a doctor and not talking to them, right? They ask you a question, you go, nah, I ain't telling you. Or you tell them, like I do, I tell them the opposite. Not really.
It's a need-to-know basis.
Now, what happens in financial planning is a plan can just be a written document, and the biggest problem in the industry is that they make a pretty little graphs, and they sell it to you, and then they never implement the plan. And so at Akers Financial Group, our goal is to implement the plan for you and your family, and then this leads to true financial independence. Financial independence is where you choose to work or you choose not to work. You choose to do what you like to do. And we call that winning in retirement. Any thoughts, Jeff?
Well, financial independence is that idea of they need you more than you need them, and that's a good feeling to have.
That's how you feel about Akers Financial?
Almost.
So Jeff's almost there. Now, I love my cash cows. Some of you probably not have heard my cash cows in a while. If you ever listen to the radio show, Winning in Retirement, on Saturdays and Sundays, you'll hear about the cow. Now, in your financial planning, we talk about the cow all the time. I want to explain the basics because the mindset of where we come from comes out of this. All right, so it's a pretty cow. We added our sunflowers, threw a little money. Hey, Jane, do you know anything about a cash cow? Like, do you know if they what they say or anything? No, not at all. Oh, Jane,
He'll show you.
All right, Keith, can you tell me, what does a cash cow say, you know? Moo. What do you think, Jeff?
Moolah.
Moolah, all right, that's exactly right. So the cash cow produces milk, but it also produces money, mooney, and moolah. A cash cow is where we actually use that cow in retirement years. That makes sense? So the basic starts with this. You have a baby calf, right? Your first calf is your first job. You have to learn how to save. Only through living within your means can you make this money last a lifetime. But you got to start with a little baby calf, your first job. What does it require, Jeff?
You got to save into your 401k, TSP, whatever kind of retirement plan you have at work. You've got to start somewhere. Start building that habit of saving and growing your first cash cow.
Now, Jeff grew up on a farm with his parents, and they had one cow. So he actually milked a cow on his farm. I had to go on vacation to milk cows. But we did have an enjoyable childhood involving cow.
Yeah, but I was very young. My mom did most of the milking of the cow.
All right, so we have a cash calf. That cash calf is a really big thing. But what we want to talk about is what I call real-life farm to table. We're going to not just have a calf. We're going to let that calf grow. We're going to have more. We're going to have a whole herd. We don't want to just have one cow to milk in retirement. You don't want to just trust Social Security to give you all you need in retirement. You need more.
Bunch of different cows for a bunch of different purposes.
Exactly right. And so these cows have different names: stocks, ETFs, Roth IRAs.
Life insurance, fixed annuities. I already mentioned 401ks, retirement plans, those kinds of things.
Yes, imagine these are cows. These cows are growing and growing and growing. And as we get close to retirement, what we need to do is work on a plan. Because of each of these cows have a purpose. They have a purpose in mind. Each investment has a purpose, a risk tolerance, a time horizon. It has a taxation in mind. So our mindset is this. We built this portfolio mixture. Now, sometimes we're paying too much tax now, so we want to defer to the future. Bottom line at Akers Financial Group, we love Roth IRA. You pay tax now, never again. That's my favorite. Any money we can put in there, we want to. As we talk about everything today, we're going to talk about these tax brackets, maximizing, not minimizing what we're doing.
Yeah, I've never met anyone who didn't like tax-free income. That's the best kind of income.
It is good.
Yeah.
All right. So each cow has a purpose. They should have names unless you're going to have them for hamburger.
Actually, my mom did name a cow one time, and then they sent it off to slaughter, and she cried for a week.
All right. So one of the key things we want you to remember in retirement is that it's wonderful to see the stock market going up for a decade, right? The hardest thing is this, is big losses are hard to make up. That means if there's a big hit in the market, like in March of '09 when it hit the bottom after the mortgage crisis, it took the S&P 500 4 years to just get back to where they were.
Yeah, if you lose 50% of an investment, what's the rate of return you need to get back just to break even? 100%.
100%.
Somebody's listened to us before.
Now, investment people would say, I made 100%. And the reality is, no, you didn't. You were here on top of the dirt, you went down in a hole, you down here, then you came back, you finally popped your head up. So in our design of our portfolios, we have our stock and equity portion backed by gold and other pieces. At 3 o'clock, we'll talk about that. Then we have our protected side. We don't have bonds that lose when things are bad. We have protected. We ladder them out so that when something terrible happens, like we've seen many times since 2001 especially, we don't lose. And that means in '09 when the market went down, by fall that year, our retired portfolio design was already positive again, out of the hole. That also means we don't fly up with the S&P every year when it's going up, but we're prepared for the worst of days so that your money lasts a lifetime. So understand, big losses are hard to make up. Try to remember that. Now, this other thing I learned from Julius Westheimer, my favorite radio financial person growing up was Larry Burkett and Julius Westheimer. He would say 100 minus your age is the amount of money you want to have in stocks or equities. And then my wife's a math major, and I made sure if I dropped the formula a little differently, and I said age equals protected, if that was okay. And she said yes. So if you're 60 years old, 100 minus 60 is 40% in the equity market. That's like a normal allocation. You can be more aggressive than that, or if you need more income, we take less risk than that. But age equals protected, and that means money we don't lose when things go bad.
Right. We have to have something set aside that's not going to lose. And in this, you can see stocks, mutual funds, ETFs, variable annuities, bond mutual funds. You notice they all have a little line that goes down under them. They can go up, but they can go down. So they are not protected. They're not what we want for that protected side. On the right-hand side there, you see the fixed annuity or fixed index annuity, fixed annuity, CDs, and cash. They might not earn as much, but they don't go down when the market goes down. So you never go backwards, you can only go up.
Yeah, so the last two things under guaranteed are banks, which are backed by FDIC, or insurance companies, which are backed by the assets of that company. Now, insurance companies have to have a surplus above what they have on deposit, and that keeps them solvent. If they dip below, they get taken over by another company in the insurance industry. So what we're doing in our portfolio design is we're giving up something to get something. We're giving up something to get the guarantee where our portfolio will have ways to use the money over time.
Brian mentioned earlier, 2008, 2009, the market went way down. If you're in stocks, the value went way down. If you had something in one of these, okay, you didn't go up a lot, but you didn't go down at all. And if the market's dropping 50, 60%, it's kind of nice to earn zero. Sometimes zero is our hero.
Right. So as we're building this out, we want to try to explain some basic things, and that is that annuities come in 4 types. There's 4 kinds. Have anybody ever heard a raunchy guy who has an investment company? Sorry, that's the best way to put it. Well, he says, I hate annuities, but remember he was on TV for a while, then he disappeared, then he came back. But he's an investment guy who charges about 1% higher than we do. But he comes across this website called I Hate Annuities. Now, I hate annuities. There's actually 4 kinds of annuities, and we agree with one of the annuities we do hate. The other ones have their purposes. Annuities, you got to think of, are tools. They were designed over 150 years ago. These are not new products, new things. These have been around since the 1800s, in some versions since the 1600s out of Europe. So we're going to cover 4 types. Annuities, I have a diversified portfolio of them. Variable annuities have lots of add-ons. I call that like ordering pizza. If you add on toppings, they charge you more money. Well, variable annuity, every topping costs you more money. That's why they average 3 to 4% in fees, and they can really reduce the money that you make. So what is the right annuity for you? Back in 9/11, we wanted to have an investment that wouldn't lose when the world fell apart. Sitting in my office, Jeff was with me at that time, and the markets were closed for the rest of that week. And then on Monday, the markets opened up. I mean, they opened the door up, but the market went down, and all the bonds went down. In the markets out there today, all the design are taking the stocks and rotating them into bonds as a form of safety. They call those plans target date plans. But when they move to safety, the word safe isn't what they're getting. So last time in 22, when interest rates went up, the bonds went down, and bonds lost like 15% when the market lost 15 and 30 that year. And that really isn't the protected combination we want for our retirees. So our core belief is not to take risk with our fixed income. So some people might say, oh, I hate annuities. We're going to talk about what we like and what we don't like.
Well, the word annuity just means a lifetime stream of payments. That's the definition of the word. So the first annuity is called an immediate annuity, and that means you start taking the income immediately. And then it's going to pay you for either a period of time, it might pay you over your lifetime. You get to decide that at the beginning. In essence, you give the insurance company a big chunk of money, and they send you paychecks every month for the period of time that's been determined. Maybe over your lifetime, maybe over a certain period of time that you want to get it.
All right. If you don't have a lot of money saved and we want to squeeze what you got to give you more income, we can do this. I had a lady where we could qualify her for public housing by taking whatever's in the bank, put a media annuity, give her $350 a month for as long as she lived, and she also got subsidized housing. So these annuities are tools that can use in the right situation. So the concept of I hate them, I don't want to use them, well, it's like having a toolbox. Oh, I hate saws, so I need to figure out some other way to cut a board. They have their purpose. They're not for everything. Media annuities is just a tool. For income, we don't use them typically at Akers Financial. Now, the annuity next would be our fixed interest annuity.
Okay, well,
Yeah.
Okay, these
Your
are
glasses?
the multi-year guaranteed. Yeah, glasses are in my pocket, but
These are called MIGAs,
Yeah.
multi-year guaranteed annuity, but you don't need to memorize that.
they pay an interest rate, usually a little bit higher than the bank for a certain period of time. One of the nice things about annuities, if it's not inside an IRA already, is that the interest is tax deferred. So you can put off paying the tax on the interest until later on when you actually take it out.
Or
Now,
make your kids pay the tax.
Right. Sooner or later, somebody's going to pay tax on it. If you die and leave it to your kids, they've got 5 years to take it all out and pay the tax on the interest. But it's not your problem.
On this example, we use 5%. The interest rates have been going down over the last month. There are some companies that have high ratings that still offer 5 for a 5-year period. These multi-year can be 3-year or even longer. In the interest rate environment we're in, if we use a MIGA, multi-year guarantee, we're trying to ladder using CDs and treasuries, year 1 year, and 2 year. Interest rates are starting to go down recently. They'll probably go down more once the federal government gets back to work and they report all the unemployment. Then the markets will probably drop some, and what you'll see is interest rates be pushed down at least possibly 2 more times this year, maybe up to 50 basis points. So locking in a rate longer at this time gives you a rate while the market interest rate drops. So it's not a bad idea for safe money. These are not liquid money. These are locked in. You might be able to take 10% out. Those are the kind of rules.
There's a penalty for taking it out. Similar, there's a penalty with take out a CD, but the penalty on these would be greater than that. But with a CD, the bank gives you like a week at the end of the term. With a MIGA like this, you got a month, 30 days to make up your mind about what you want to do at the end of the term.
And the thing that we've been doing since 2002, April 2002, that's when we started using index annuities, because these sort of came out in 1995 as the S&P stock market options and futures allowed for the ability for insurance companies, instead of just offering a rate, they could give you a rate tied to a stock market index. So as simple as we can get on these indexes, we like tying to the S&P 500, the NASDAQ, things like that, where if the market goes up, we go up with it to a cap. Market goes down, we don't go down, we make zero. And this type of thing can be done 1 year, 2 or 3 year. I like 1 year generally, so you just see what's going on. You're never going to make what the market makes. You're also not going to make zero. You're going to make somewhere in the middle. With interest rates doing really well, a lot of our older annuities, as they renew, we are shopping those rates upon when you get out of the surrender. When you shop those rates, what you got to watch out for is you are locking it back in again for the 5 or 7 year period of time. So you got to make sure you know that.
When interest rates were dropping, how many people refinanced their house to take advantage of that? Nobody. Oh, one did.
I did.
Yeah, I did. Well, now interest rates have gone up, and so it's a good time to refinance your annuities that have lower interest rates into something that you can make more.
An example might be certain companies paying like a 4 or 5% cap. Now you can get 9.6% cap. And that's every year. Pretty good. So that's the basic of index annuities. Out here, we're going to have a table over on the left here. That table is going to have advisors all day long from our company where we can answer any question that you have as these topics come up. We're going to be rolling through these classes, basically 8 separate classes. We're running through our ideas and thoughts. I want you to understand the core beliefs on why we have done everything we wanted to do for you, and make sure you understand where these fit in your portfolios and why. Why do we do this? Now, the last one is the variable annuity. Everybody can say boo.
This is where we agree. We hate variable annuities, for the most part.
Well, sometimes somebody has them and we take them over. So as a licensed stockbroker, we can be the rep on your variable annuity and we can teach you what the stockbroker did not teach you. And that's how to use it. The amazing thing is stockbrokers many times take withdrawals out of it, but you've been paying like a 1.25% fee for an income rider. Income riders give you a guaranteed payment for life, even if you run out of money. I believe heavily in using those riders because one of the things is, what if we outlive our money? What if we have longevity beyond normal into the 90s? If there's a healthy couple, 2 people at 65, 50% chance one of you will make it into your 90s. Will your money make it into the 90s? And that's what an income rider can help us do. Variable annuity layers their fees together. What kind of fees? You say one fee, I'll say a next fee.
Oh, contract fee.
All right, mortality fee. They guarantee death benefit even though they allow you to invest in the stock market, so they charge you for that.
Sometimes an extra rider for the death benefit too.
And then internal investment fees that are like mutual fund fees, 0.5% to 1.5%.
And they might have an income rider with another fee.
All stacked on top, 3 to 4.5%. So if you're in a variable annuity while accumulating, you can be risky, but when you want to lower your risk, let's say you lower it to a 6% portfolio and all of a sudden you take out 4, you're making 2. So that would be what you got to watch for. Most people in the room we know pretty well. You don't have those. So. But when you hear the word I hate annuities, this is what we would say. We agree with that. All righty, so we've been through the 4 annuities. We're back to the cows.
Ooh, now to milk some more cows. Okay.
Well, cows are made for milking. When's milking time? It's retirement. Retirement time. We want to milk cows, not eat the cow. I know Dean likes steak all the time, but the problem with that is the cow's not going to be there tomorrow. So, sorry.
I like steak too. But
So if there was a farmer in the room, they'd say, we don't eat the cows. They're milking cows. We eat steers. But my story doesn't really work for that. All right, so retirement, the job stops, the milk starts coming from your investments. Now, if you have Social Security turned on, your pension, you might not need your investments until you have to. Normally, in your portfolio, if you have interest and dividends and you're paying tax on it, we push that to your bank and you start living off your interest and dividends instead of reinvesting. And then when you're 73, 75, that's when RMD comes in. And you got to take money out, need it or not, got to pay the tax. Or we do something called QCD, give it to charity, which is our 2 o'clock topic.
Yeah, that's a wonderful thing. Remember tax-free? Yeah.
All right,
QCD is a way
cows
to
are
do
for
that.
milking. Income to last a lifetime is what we're trying to do. Inside of fixed annuities, we can add income riders for a fee. And that fee does bring down the value. But when you turn on like an RMD at 73, by mid to late 80s, it runs out of money, but it'll keep paying you for as long as you live.
It can pay you for a lifetime, and there are some that payment can even increase over time.
Yeah. All right, so Jeff, this is your topic
All right,
here.
yeah, life and long-term care. You know, about 70% of people over 65 are going to need some form of long-term care, and it can be very expensive. If you've ever had a loved one that needed it, you can see that. So the insurance industry came out with traditional long-term care insurance policies years ago, and it's a little bit like car insurance. You pay all this money into it, and the rates can change. They go up over time. I've seen a lot of people come in and say, hey, I got this rate increase notice, and they said, I've got some choices to keep my rate the same. What are the choices? Well, let's reduce the benefits. So it can be very expensive, and the premium can increase. And at the end, if you ended up not needing it and you pass away, well, that money's just gone. So there is a form of long-term care insurance where you're using life insurance for it. The life insurance death benefit can be used for long-term care. You can also buy a rider to make it last longer than just the death benefit. But in that case, it's still expensive. I'm not going to fool you about that. But at the end, if you ended up not needing the long-term care, there's a death benefit that goes to someone. It's not money that's just thrown away. So,
tax-free. Life insurance is tax-free. It's a wonderful death benefit. Roth IRAs tax-free, life insurance tax-free. So using life insurance as a tool to provide for possibilities of high cost. With the baby boomers draining long-term care, health care, and the facilities, they're going to get even more expensive. Harford County, it's $10,000 to $12,000 now for a full nursing care, basic, without a fancy room.
per month.
Per month. Yeah.
Yeah, it's very expensive.
Yeah. So at retirement, at early years, if you want to retain your legacy and not self-insure, you could buy insurance for it. If you want to self-insure, you can use the money you have. You might need $500,000 or more to provide for that care, and the rest of it will go to your kids. I strongly believe that your money is your money. Whatever's left goes to the kids or your charities. So we got to provide for you. Life long-term care gives us the balance of having money to know we're caring for each other, or in a situation with a husband and wife where it's very expensive when one's in nursing care and one's still living outside. It can be like double the cost. So these are our topics on the protecting the nest egg. We want to remind you of our core thoughts, and that is 100 minus your age is the amount of money in stocks, but age is your protected portion. As we get into our 70s and 80s, that could be only 20, 25% in the market. And that'll be dictated based on what you need for income. More income you need, the lower the risk. You don't need the income, we can stay high risk if you like. And then on the index annuities we do?
Yeah, we did that instead of bond funds. Bond funds can go down. We want something that will not go down.
All right, and that's our
That's
topic
protected.
we've been doing. Thanks very much, Jeff. Our speaker, you can have a seat if you like to, sir. Sam Payne is, I'm not going to say your age. I'm going to skip that topic.
I'm old enough to know better.
He's old enough to know better. He's
We're
a
gonna try
a certificate holder for the National Association of Social Security,
Yes.
where he's done a lot of studying on the Social Security laws and can be an instructor on those. And so him and I have a radio show tomorrow, 10 a.m. on WCBM 680, and 11 o'clock on 105.7 The Fan, and 9 o'clock on Sunday morning on Social Security. So it's an hour long of what we're talking about right now. So what we're going to do is jump right into our little talk here. Social Security has been around for 90 years. 90 years ago, they started taking it out of our pay. They didn't start paying it out to 39 or 38.
I think it's 39.
I think 39.
Yeah, the bigger question is, what was the average mortality age 90 years ago?
This is the funniest thing. All right, you get Social Security at 65. Average mortality was 63. Now, the math of Social Security should work really well, right? It should. That's just the way the math is. Now, average lifespan on Social Security is 81, 82 for men,
Yeah.
83, 84 for female.
Yes.
And then you guys are so healthy, you're living into your 90s, and Social Security is like, we're done. We don't have enough money for that. So that's part of the story, right?
That's part of the story.
But not all of the story.
Yep.
All right, so 90 years old, happy birthday to Social Security. There's 4 topics in this section. One is Social Security Fairness Act. Second one would be the promise of no tax on Social Security. It's the whole OBA, one big beautiful bill talk. And will it be there for me? And then the last bit on drawing. All right, so you ready to roll? We're going to be flying through these ideas.
So has anybody heard of the Social Security Fairness Act? That's another oxymoron, right?
Well, if you're a civil service, right?
Civil
Federal
service,
civil service,
yep.
Baltimore County Fire, Baltimore City Policeman, some other jobs that never had Social Security out of their pay.
Right, and what it did, it reversed a move that was done in 1983 when they applied an elimination period for windfall elimination period for those who have public pensions. So it reversed that. So all those people get the Social Security benefit that they paid into, that benefit took away. So it is fair. It's giving them back something that was taken away in 1983, and they took it away in 1983 because they were worried about the longevity, the financial stability of Social Security. And now they give it back when we're already worried about this financial stability. It just adds to the issue.
I actually agree that when Biden and his group put this through in January of this year before the new president came in, and I believe that this is the right thing.
Yeah.
So what happened was, if I was a Baltimore City police officer, my pension I never paid Social Security on.
Right.
But when on my days off, I had another job, I paid Social Security for that. Under that elimination period, I was not allowed to get a spousal benefit. I couldn't even get all of my Social Security benefit that I paid in for. And so I believe it's the right thing. Now, it did cost Social Security in the billions and billions of dollars. What we have found is that most of our clients have been paid out lump sum, and their monthly has changed on that. And so the key thing is really that, sorry, I was watching Sam trip over the light there. The big thing is that the monthly checks are coming, but some of us, because we've never really had the Social Security check be that large, weren't withholding taxes, we need to change your taxes. So if you have this situation, we're waving a flag, let's do a tax calculation, have taxes for this year. You might need us to do a tax estimate. Make sure you don't get a surprise when you do your taxes. Now, that's the Social Security Fairness Act that happened in January. By June, everyone's effectively paid out. The only caution would be is if you had never applied for Social Security yet, you need to apply to actually get it.
Yes, absolutely.
All right, let's roll to the next one, which is, will it be there for me? We just handed out to you what the Social Security has put on their website. For years, they put on your Social Security statement that in the future, we're going to have to lower your benefit if nothing changes. Mm-hmm. This started in the 90s. This was on every statement. Now the numbers work sort of like this, I guess, right?
Yep.
So Social Security and the trust fund will be able to pay all the benefits in full when they combine disability into old age until 2034. In reality, though, they keep the two plans separate. OASDI stands for Old Age and Survivorship Income. That money will last on the way it is until 2033.
2033, right. And then they'll have to cut it how much?
23% is what they're telling us.
Yes.
So what Social Security is warning us in their system, let me get to this slide here, is that they're going to cut our benefits 23%. Mm-hmm. Now, Sam, what's your opinion of that?
I don't think they're going to cut the benefits, especially for those that are currently receiving Social Security. Historically, any changes that have been applied to Social Security, those individuals who are currently receiving the benefit have been grandfathered in. They weren't affected. I think that group of individuals, those that are receiving it, need to know that there's something on the horizon that might maybe affect them. But I don't think it's any reason to go out and do some incredibly different planning than you're doing already. Hopefully, you've already got a good plan in place. I think those that are already receiving Social Security will be grandfathered in, and there are things that can be done to fix Social Security to the extent that they won't have to cut those benefits. Question is, do we have the appetite to do that, right?
Right, so how we got here is that the increased longevity, like we talked about a little bit earlier, there's been lowered birth rates since the 70s, and those 60 million people or more reduction has caused less people to pay in. So in 2021, Social Security taxes are bringing less in than what they're paying out. So they have a negative cash flow, and that's why they have the concern. And that's why when they tell us 8 years from now, if there's no changes, they're going to have to lower. That's where it's coming from. Lower immigration, that's on the line, right? Mm-hmm. It should say lower legal paying their taxes, Social Security tax, immigration, right? Because I think it'd be wonderful to have everyone pay their taxes, pay their Social Security. That would be helpful for the system because of the math. We need more Social Security income, taxes to come in to cover those that are getting paid.
And this country was built on immigration, legal immigration.
None of us probably would be here without immigration.
Yeah. Mm-hmm.
So political inaction means no one wants to touch it, so they don't change it. Yeah. There's a couple of changes in the last 15 years, but most of them did slight changes. There have been low returns because there really isn't a trust fund investment. It's all in the federal debt. Federal debt was paying very low interest rates. Rates started to rise a couple of years ago, but not much. And then COVID-19, people stopped working for a long time. Federal government sent money out for people, especially like my niece. She was a waitress and stuff, so she got income without any Social Security tax on it. And so what ended up happening is there wasn't anybody paying in at all. So that was actually a negative year in 2020 because of the effective tax coming in. Mm-hmm. So these are reasons that we got here. The next step of this is what can they do to try to make things change?
Well, they've already talked about the benefit cuts. That is one answer. That is one thing they can do. But they can also have tax increases and other ways to deal with it. There are a lot of things that are on the table right now, and the politicians who are talking about it behind closed doors have a lot of things they're talking about. Means testing is one, extending the early retirement date, extending the full retirement date, maybe doing away with the deferred date. That's another one. Increasing taxes, increasing the level of workers' benefits that are taxed up to $400,000. That would do something. So there's a lot of things they can do, and I think they're going to do to maintain the stability of Social Security, because we, the people, have paid into that all our lives, and we expect to get some kind of a benefit out of that. So I don't think it's not going to be there. I don't think that's the case. I think it may be there in a slightly modified version, especially for those who haven't claimed already. But those who have already claimed, I don't think you're going to see any difference. Now, this is just me talking. I don't have a crystal ball, but historically that has not happened.
So like on the radio show tomorrow, we're going to talk about 3 categories of people. One is drawing already. Our general belief is that benefits should stay the same. You're probably not going to see a lot of cost of living adjustments. Under the law, they can do adjustment, cost of living, like 2.7 next year is the estimate, but they're going to take most of that away from Medicare. Medicare is more poorly funded than Social Security. That's going to lead to trillions of debt just for the Medicare system the way it's designed now. The second tier is people that are within like 5-10 years.
I would say if you're 10 years or more, 10, maybe 15 at the most away from retirement.
So about 50, age 50 to 60.
Yeah, you need to sit up, you need to pay attention, because there is something on the horizon that might adversely affect you. If they make some changes to the eligibility for Social Security, that's going to affect that group. So if you're a few years away from retirement and you haven't started considering whether Social Security might be cut or whether you've got enough money for your income needs in retirement, then you start putting together a plan to offset any potential cuts. The third group is that group that's what?
It's really the kids.
Yeah.
Like if you think about your kids, the younger group, that Social Security will be different. Different in a lot of different ways. We think that the beginning age could go higher, like maybe 65 is the first time. Right now, 74% of people draw at 62. Social Security likes that. You draw the lowest amount, usually a 30% cut from an age 67 full retirement, but generally you lock it in early and you get paid. But Social Security is going to adjust things, and then they have to. Anybody heard of IRMA? Income Related Monthly Adjustment Amount. And that is where if we are single or married and making basically about $108,000 on your tax return, adjusted gross income, or married at about 216, 218, once you get above that, you don't have just the Medicare at 185, they start to penalize you. They penalize you an extra $70 is what they're currently doing. Once you get above, like if you're married filed jointly, above 266, you double your Medicare premium, it triples and quadruples because of too much income. Mm-hmm. That's called means testing for Medicare. I believe means testing for Social Security is coming. Mm-hmm. With OBA, the One Big Beautiful Bill, I think paying tax, converting, getting your IRA deferred money or your 401k millionaire accounts, moving them into Roth so that we can come underneath that bar whenever that day comes, could be a good long-term plan. For some of you, your income is going to be above those limits. You're going to pay the tax, and the Medicare tax is going to be part of the cost of being in America. Mm-hmm. But generally, if we can plan for it and ways around it, we want to try to do that.
Yep.
Yes, Jane?
The cap does raise on a regular basis, yes.
Well, Medicare raised the cap all the way up.
Yeah.
And they basically, no matter whatever you show, they charge. So one of the proposals, there's big committees that do report to Congress, and some of the guys I know on there, they've actually come out with the idea that we can raise it all the way up and charge higher taxes.
Yes. Yeah.
Now, in reality, when you start making about $200,000 a year, you're probably not going to get all your Social Security tax back during your lifetime.
No.
It's just mathematically almost impossible. So they probably are going to raise that up. I think that would be one of the many choices they do.
Yeah.
But the problem would be is who's going to make that decision and when.
Yeah, that's that hot potato.
But it doesn't give a lot of money, right? Isn't the math pretty low?
No, I think if they can raise it up to the 400, which is what they were talking about.
Just 400, not all the way up. 400.
Even 400 makes a big dent.
Yeah.
It should be.
Right.
Yep.
Right.
Yep.
You're talking about the percentage or proportionate? Well, $1 million you would pay to 7.65. Oh, that's right. Yeah, right now. Right. Yeah,
Yeah.
correct.
So they're not really paying 7.5. They're paying something sub that.
Yeah.
So somebody making 60 or 70 is paying the full 7.5 plus.
Yep.
Right. So what happens in the Congress is that they're going to have committees for this. In Maryland, you just have to watch our congressmen and make sure that they are actually pushing towards something that's going to make this balance out. We think there will be a balanced answer
Yeah.
to help people that are getting current answers someday.
I don't know why that's not done. More people not making that.
I've been to Congress, and I can tell you that
There's a lot of things
I
in
knew more
question.
about the bill I was talking to them about than them, and they wrote it. So
Yeah.
I don't have the biggest faith in things at times.
I think there's a lot of things on the table. Just suffice it to say, they're
Yeah.
looking at a lot of different ways to fix it.
Absolutely. We're going to have the question and answering section out there for you guys to ask more questions. We're trying to keep all of our talks pretty tight, a lot of topics, trying to address how we see things so you know how to handle all these things that are facing. The one big beautiful bill, the promise was no tax on Social Security. Remember that?
Mm-hmm.
Well, when you do the bill the way they did it, you can't affect Social Security taxation. It's not even allowed under the way you draw up the law. So they came up with a senior tax exemption. Senior tax exemption, if you're over 65 years old, you can get a $6,000 per person additional standard deduction.
Yes.
Now it's limited by income. So married filing jointly is $150,000 up to $250,000. It fades out. So now we're watching tax brackets, IRMA limits, and this exemption limit.
Yeah, and what's the limit for the tax deduction for a joint married couple?
It's $150,000, and so single is half. $75,000 starts to fade away.
But it completely phases out at $250. So you think of IRMA. You just talked about IRMA doubling at $266,
Yeah.
and the $12,000 deduction phases out at
It's gone.
$250. So if your income is up there, you're not going to get a lot of the benefits that are being touted, unfortunately.
So the one big beautiful bill is basically a permanent bill for tax brackets, and we'll be
Yes.
covering that in the third hour. The tax brackets are going to be permanent for personal,
Right.
but all of these other things, basically no tax on tips up to $25,000, no tax on overtime, even the Social Security, no tax on Social Security, which is senior tax exemption, is only for 4 years, and then it goes away. So it's none of that's permanent. It's not like we should change our life to try to adjust to it. But if you're close to the bar, $1 over, you're going to basically phase out. They're not going to take it all away from you. So just understand that basically. And then this topic here is key to drawing. This is one of our big things. If any of you have not drawn yet, we want to go over some ideas.
Yep.
So what age should you draw? In America, 74% draw at 62 because they see that as their target. Oh, government says 62, I'm taking it. I don't care what's going on in my life at that moment. I'm stopping, getting to 62, if I'm ready to retire or not. We have some people come to our office for the first time, and they say things such as, I just retired, I'm drawing Social Security, help me stay retired. And I'm like, a little late. I wish I could have talked to you before you elected all those pieces and waited and made the right decision over time.
Mm-hmm. Yes, and so the begs the question, when's the right time to claim Social Security?
Well, let's go a little bit on the detail of penalties for drawing early.
Okay.
So full retirement age, if you were born in 1960 or later, it's 67. Born in the 50s, it was at the end of the 66 and a half.
Anybody
69.
born in 1960 or later.
Yeah.
Yeah.
So what happens here is that early versus late is there's a penalty for early versus late. So we really got to watch out for if you go from 67 to basically 67 all the way down to 62. This one shows a 32.5% reduction in the spouse's benefit. There's also a 30% reduction in your benefit.
Yes.
And that's based on the pure number. Now, the reality of 62 is you get the money sooner, and it's in your hand versus waiting. If you wait, then draw, you then have a time period to break even. Usually 12, 13 years is the math.
Mm-hmm.
So if you start at 67, you'll be around 78, 79, around 79, 80 is about break even. That means you want to live that long. It makes sense.
And the other reality is if you claim at 62 and Social Security isn't enough to meet your living expenses and you got a side job, you run the risk of maybe having your Social Security taken away because there's an annual earnings test. And that earnings test sits there until you reach your full retirement age. Then you can earn as much as you want and receive your Social Security benefit.
That's around $23,400.
Yeah.
Now, a general belief in financial planning, if you need the money, draw it.
Yep.
If you need the money, you
Yep.
got to take the money from somewhere. The other idea is that the spouse with the smallest amount would draw first. The one with the higher benefit would wait. When you have two spouses, the one with the higher benefit, that becomes the benefit for the family if one passes away. So letting that grow makes a lot of sense. If your ex-spouse, were together for more than 10 years, you cheer them on to do really, really well so you can draw their benefit when they are no longer around.
Yes. Yep.
But you can't be remarried at the time. A bunch of little rules, but there's a way. So we have a question and answer thing, but also your advisors, we have the ability to calculate the ability of break-even points and all this stuff on Social Security. And it comes down to what is the best time. Is it 67 or is it 70? What do you think, Sam?
Well, we've had this discussion, and I'm standing by my original comment.
Yeah.
I think it's 870.
And why 70?
I think oftentimes what I've seen is you have individuals who have different earnings capacities, earnings histories. And if one has a substantially lower earnings history, then waiting as long as you can to get the biggest benefit leaves that person a survivor benefit that is elevated already. Now, that being said, I think the real answer is it all depends. It depends on your specific situation. What's your health like? What's your longevity in your family? Are you earning income now? What are your other investments? Is Social Security filling all your income needs? Those are the questions I'd be asking at 870.
So 70 is the longest that you can wait. We had one client, I think he was 73 years old, working. He was afraid if he drew Social Security, he'd lose his health care. We had to convince him through lots of documentation, right, Jeff? And he drew, and all he could get was 6 months back, and he missed like 2.5 years because he didn't draw it. So 70 and a half is about the longest you can wait before you take your first check. Then you get it. So at 67 is your full retirement age. If you wait, you get 8% more a year for waiting, but you don't get the money. Your spousal is only calculated till 67. They don't get half of the increased amount while you guys are alive.
Mm-hmm.
They will get the full amount if one of you passes away.
Mm-hmm.
I'm a 67 person. I like 67. We can work to whatever we want. I usually like January of the year we're 67 if you pinned me down to draw Social Security, get that money going. And that flow of money will then allow me to take less out of the portfolio. Now, if we're in a situation where I want to maximize Roth conversion, minimize all other taxation, I push Social Security to 70 and I push my income in and get money to Roth because I want the overall plan to be tax-free down the road. And that's all calculations that our team of advisors will do for you.
Yeah.
I hope that wasn't too complex, but the general idea is we like Roth. To get money there, you got to pay tax. The more we want to shift over, to get more shifted over, we got to show less income. And we do that by waiting on Social Security if we have that as an option.
I think it's suffice to say that there is no hard and fast rule of when to claim.
I'm also saying not to fear the fact that Social Security has some issues, that we might
Yes.
not get all of our money.
Yes.
It's part of the calculation, but I don't think we should just draw because of, I might not ever get it.
Yeah. I
The
agree.
concept might be we might get less, and that's definitely for younger people that are under the baby boomer limit. I think those are the ones that have to be concerned.
Yep.
All right, so 67 versus 70, I don't think either of us won that one.
Yeah,
I went on your
I
side there
think
for a
I
minute.
kinda- yeah, you did. I like that. Yeah.
So the oxymoron, Social Security is social and security?
Social and security, it's still there. It's
Yeah.
still serving what it was originally intended to do, which was to pull seniors
Even
out of
government
poverty.
shutdowns, checks come on Wednesday.
Yep, they're still coming. So,
Yeah.
like you said, I wouldn't be concerned about Social Security not being there, but I would, if you haven't already, sit down and create a plan of how Social Security is going to fit into your overall plan.
All right, so as we do these sessions, we have about 50 minutes. We do 2 different topics. Then we have like a 10-minute break. And then we'll come back again at 2 o'clock. And the next one in this room is going to be estate planning and then charitable and legacy giving. We're becoming some new ideas like donor advised funds, things like that. Thank you very much. We'll talk to you more later.